Welcome back to Making Money Matter, ladies and gentlemen. I'm your host, Kerry Stevenson. And today, guess what? Sit up and take some notice. Francis Hunt, known as the Market Sniper, is back. Now, the last time I spoke to the sniper was 2 years ago. Francis Hunt, 2 years ago on the other channel. It was September 2022. Lots has happened since then. And ladies and gentlemen, you go and find him on YouTube, Market Sniper. You can also go and have a look at his website, themarketsniper.com. But he is first and foremost a trader, and he's also devised the Hunt Volatility Funnel. We'll call it the HVF. Now, that's a trading methodology, and it's there to find opportunities in the market. But the one thing that I know, and you guys will all appreciate this, is he's a sniper. So he aims, he fires, he's straightforward, and he's going to tell it like it is. There is lots going on. The last time that we spoke, which was 2 years ago, Francis, you said the great monetary reset is here. And you also said that the US dollar dominance will destroy the current system. But before we go into all of that and we start sniping, first time on the channel, give our beautiful audience out there a little bit of background of who you are.
Yes, absolutely. Macro technical. So we start on the very big time frames first before we zoom in.
Okay.
A bespoke methodology that you mentioned, thank you for that, the Hunt Volatility Funnel moment, which is the tradable element, which is where we get most excited. And I would say in terms of the big calls that we've made, we made various Euro, Swiss franc, collapse calls in 2009 before the Greek crisis was known and the peg fail. Most recently, around the events of March 2020, we called for the oil to fall to a single digit for the first time in 30 years in 2019. All this came from technical assessment. We were short cruise liners as well, which was counterintuitive because obviously one of their biggest costs is oils. And then we got the event. So we see things technically first, and then we make the calls no matter how counterintuitive and conflicting they may be. And subsequently, we get the story as to how that could happen. So we're the news before the news actually takes place. And I'll be referring to that because I would say probably in tandem with the gold long oil short. Not only was it an oil to single digit, but it was actually a gold long call that saw the 2075 run all the way up from around 1400s, 1200s. In fact, we'll check the chart again. At the same time that oil fell from around 70s right the way down to single digits in a glut. So that was an incredible trading event. We did a case study for that. People can see it on our site, all the different YouTube. So anything we say we've done, we can back up with the timestamps and all the different updates with charts as well. And that was very big because on top of that, in the same year, which saw March 2020, obviously saw a lot of the actualization of 2019's calls. In 2020, in August, we actually stated for the very first time, and we don't make calls on the bond market particularly. I watch it more as a barometer of economic health and various other aspects. So we don't trade it particularly. Apart from the TLT, there's not that much. You can open a commodities account, I suppose, and short the bills. But it's never been something I've typically done. So it was our first major macro call. And we said in August 2020 that you have had peak bonds. The 40-year bull market is absolutely over. And in true form to our news before the news, I take great delight in sharing the screen and saying, you now get zero hedge over here. This is literally 2 days ago. The 40-year bull market in bonds has ended. This is 4 years later with Mr. Fleckenstein and Rosenberg. So when I say the news before the news, people have forgotten often a lot of what we've said by the time the mainstream, and zero hedges before the banks and the FT and most of the others, I will even say, before they even come out with it, you got that news. So what that actually means for people to understand are a couple of very core things, Kerry. First of all, you saw the death of the 60-40s. People only started realizing that after they had 2 dreadful years in 2023. That's a year ago, after they had 2021, 22, and the debt market absolutely spilt its guts. So what happens is when you get an extremely fast rate hiking sequence, there's a consequence to that. The debt valuations are going down at a commensurate level. And when you've gone super, super low in the debt markets by valuation, what you've actually done is you've geared up very small moves to have massive meanings. So if you go from 0.5% to 1%, you actually doubled the rates, even though it's not a significant move, which has an amplified effect on the valuation of the debt markets. So we called also, and we mentioned the TLT ETF. We bought puts on the TLT ETF after making the call August 2020, which followed. So first we had the events of the pandemic of 2019 that we were calling. We could see that something was setting up in 19. Wow. You had the events, their reaction to the events set up our next macro trade, which was, that's it. Our first call on the bond market, 40 years is over, and we said it in August 2020, and we bought early. You needed to be early. The biggest mover was the TLT, and of course, it collapsed substantially. Now, people have to understand and remember, bonds are meant to be boring, super stable things that earn a small interest rate that basically kind of mitigate inflation. They don't really, but anyway. But their capital values move in very small levels. However, when you exploit a system and you turn it into a 40-year financialization of everything, where you can go to America and buy a car for 90 months and only pay 40% of it off and a balloon payment for the rest, you've got to understand this is the financialization parasite that has crept into every single industry, has so hopelessly overextended and created so much debt. And I laugh because there's some people on X that say, well, there's going to be a shortage of debt because it's collateral and all of that. If it's one thing we do not have any shortage of, it is the issuance of debt by governments, particularly, also businesses, but particularly governments. So that call in 2020 has absolutely set in motion the reset. You are currently living the reset because those same debt markets are substantially reduced. So we did a Substack article to explain this, because to a lot of people, the bond markets are boring. I was never interested by bond markets. I understand shares, companies, and things like that. Mining as an activity, for example, everybody can get that. Bond markets we glaze over, and the financial markets actually are glad about that, and they go out of their way to make it sound as mundane, boring as possible. But your entire system is underpinned on this. Every dollar has been borrowed into existence. So there's kind of a T-bill accounting. Oh, okay, you went to the bank, you got money to buy a house, you now created a liability for you and an asset for the bank. In fact, they own the house, you don't, until you've dismissed the bond. So with that understood, people need to realize that actually the underpinnings of this entire market and the ability for government to continue to overspend is now in challenge. So we saw, and it's been that long since we spoke, so we have to, and I understand you met Mademoiselle Truss, who was thrown under the bus. It goes quite nicely as a rhyme. I should do a little rap or something. I don't know what I do with Kwasi Kwarteng, but anyway, they ended up under the bus. And I pointed out, if you followed our YouTube content, as much as I'm no fan of any of the politicians, that actually the Bank of England was at fault for not matching the American rate rises. And as a result, they were not deflating their debt accordingly and increasing the coupon to attract new buyers at the same way that America was. And macro bond funds can just go, okay, I sit in a losing pound with a lower yield, or I move into the dollar, which is currently strengthening, and it did during that period, as you know. And I get a capital appreciation, and I get a cheaper price to buy that treasury because the yield is higher. So you buy cheaper, you have more chance of capital gains, and you get a better coupon. What happened? Money flowed out, and then they said it was her budget that would have added additional deficits. Now, it kind of would have been an extra straw. There would have been more deficits, but actually the rate setting of the Bank of England should have gone up with the Americans, and that would have at least given her a little bit more support for her policies. So it was more a case of they're disjointed and via the entire UK complex, where there's the permanent government and she was just the, the newbie for the moment for the next 4 years. That turned out to be 1 month in the end, I think. Anyway, so debt markets, and the British Bailey recently said, now we were discussing this beforehand, we could cut. So America has cut now. We could cut, but he said the quiet bit's allowed. But at the same time, we've got to watch the markets and what they will allow. Now, the markets he's referring to, it's not the stock market, it's not the crypto market, it's the bond market. And I understood speaking to you that while America's cut, also the Royal Bank of Australia has also withheld for now to cutting.
The Reserve Bank, we're not
the
Royal.
Reserve Bank, Royal, of course. You just keep the Union Jack in your flag for, old time's sake. You're right, Reserve, stand corrected. Yes, as a result.
So we didn't cut here, although they're talking, they're making murmurings, I think, to keep the slaves under control, the serfs under control, if you like, by saying we may cut. Not sure that they're going to, don't know, but it'd be interesting to hear what your views are. But I think
so there's techniques with central bankers. You can also jawbone an event to a certain degree. Okay. Which is, yes, we remain concerned, our biases to the downside, but then they wait for something to happen, and then you have a little pop up in the oil price, and they say, unfortunately, that's now less likely and taken off the table. So they get away with inactivity while still appearing to be sensitive to the hardship at the moment. So globally, there's the other thing about recession. We were in recession when we met the criteria of recession. When I'm talking particularly about the US economy, this notion that they came out with this fool's number. So there's been a lot of lies that have happened since we last spoke that I feel we almost have to build the case correctly. We almost have to set the seed and dispense with. And in our labor markets, we said it's an absolute lie. The non-farm payrolls they're totally manipulatable. They have the birth-death model. And in fact, in the 2022-23 period, I think there was about 13 downside revisions and virtually none upside until recently, by the way. But we are catching up with some history. And then, not more than about 6 weeks ago, they came out and admitted that they've had way too many jobs, and that was basically the reason behind the 50 points cut. They removed 818,000, even on top of the fact that they'd done all those revisions for that period. So to summarize, you had an event, you met 2 negative quarters. Okay. It should be considered a recession. They say, no, not this time, not this time. It's totally different. Look at the red hot labor market. And that was the sole data point, which is based on a lagging indicator with a birth-death model in it that they've consistently revised to the downside for a year thereafter, and then took an extra million jobs out and said, listen, those never were created. And on top of which, a lot of those jobs were by agencies that looked like private jobs, but they were doing recruiting for government. And they've just pulled that same trick on Friday's non-farm, as we've just had a payrolls number. This is the most important data point for the general health of the global economy, but particularly America's economy. And they had blowout huge good numbers. So now they've taken away or reduced the degree that further cuts will come. And why would they want to do that? Well, again, it was blowout government hiring. That is not productive hiring. That's new salaries that have to be paid by the private sector. It's new pension plans that have to be paid by the private sector for somebody doing officiate. It's like we took all the salaries in Australian rules rugby or rugby league and paid it all to the referees and said, no, we need better referees looking after the game. And we had 30 referees and 10 linesmen on each side, and the players went hungry. I mean, it literally is where the game of where you're paying the scorekeepers more than the players. And that's private versus government. They are needed to a degree, small and efficient, thank you. And that's the complete corollary. We are recruiting more referees whilst players are starving. And so we have been and are currently in a very recessional environment. Regardless of what statistical manipulations are saying about it, we are in a recessional environment. And labor stats is the most laggy of indicators, unlike the yield curve, which we've also been talking about a lot on our channel, and has reverted back positive after the longest inversion ever. And this is all pointing to, again, the stress in those debt markets, and that we are imminently potentially going to have a major financial fiscal crisis.
Now, let me
This
interrupt you just for 1 second, because what you said a moment ago is it's almost like they've kicked the can down the road by, it's almost like the Lehman Brothers collapse. Well, we'll put it on the book and then we'll take it off the book after it goes off. And it's all sort of smoke and mirrors. How much longer? Because a lot of, as I said at the start, 2 years ago, you spoke about the global monetary reset is here. It feels to me like we are in recession, but not to the general population, because they keep getting told nothing to see here, everything's good in the hood, nothing to worry about. But our taxes keep going up, and it all seems a little bit, how long can we keep the party going? It feels a little bit like the party of the 1920s and the depression of the 1930s. What's your view?
I think that's a good analogy. I think we should always avoid the fact it's an associative analogy. So there's lots of things that are different around that, but some of the core themes that you mean are very much prevalent here. But I would say the party, the truth of the party is that it came with the post-CV19 proliferation, and that was your party. And everything went up in cost. And inflation suddenly surged, and that was the hangover, the beginning of the hangover, where people started to feel worried about how it's going to be tomorrow, because they've already drunk 10 tequilas, and they start wondering about how they're going to drive home, and other precarious things, and then the inflation became the story. Biggest hangover of the world. You're more sick and hungover than ever before. The food was bad. You thought it was good, and actually we're in that absolute nausea state now of suspended disbelief, where actually retail and consumer is pretty hard hit. And my opinion is, if we had real statistics, that most parts of the globe would be in recession. You've also had China do stimulus. They're the same. Don't forget, they make everything for the rest of the world. So China needed to do QE and pick up their stocks. They're making everything for and everyone's ordering less. So I always say, don't nation state this. We get a lot of the US guys, they're very proud. They say, well, look how bad China's doing, we're doing bad. No, they're the factory for your stuff. You're not buying on the same scale. You're as sick as they are sick, because this is a global thing. And so that's kind of the overall picture of where we are. The debt markets have turned. Now, the debt markets, it's important also to explain that they were a reserve asset. They were considered a reserve asset. So I don't consider that. They were called risk-free rate. If you didn't I did an MBA through Bond University, Australia, the Queensland way, I think you're that way. And that was, the risk-free rate was the 10-year debt of the 10-year market. In other words, if you could get a certain level of return that was above what was available on the 10-year debt, then you were doing great. So I'm going to pull up here we go. Here's the 10-year, and I'm going to show you this if I can, and we can reflect to some of the charts. This was your risk-free rate. And why was it risk-free? Because you had the largest government, largest military of the world, that would always be good for it. That's why it was risk-free. They literally could make money up. And this was your financialization of everything era. This is yields down. What are we looking at? The 10 years yield. Remember, yield going down, value going up. So it's becoming ever more valuable. This is a bull market in bonds all the way down. And this is why I say, where are all the macro technical guys? Because to me, it's stark, raging obvious. You had a massive final capitulation in yields, strength, blow off top in the bonds. So the bonds is literally the values, is literally the invert of this chart. So you had continually getting stronger, multi-decade, we're talking 40 years. They then created so much new money.
Sorry to interrupt you in this, because I'm not a chartist, and I know some of my audience aren't either. You say continually getting stronger, but as I look at this, it looks like it's continually getting weaker. It's coming down. Am I
correct? So let's just revert that and show it to you in that way. So the bond valuation is the inverse of the yields. So when more and more money is happy to accept 1% and is just storming in, So just a short explanation, because so many people, and I actually did an audio boom mini, and I will send you the link. What do bonds, layman's explanation of bonds, because so many people struggle with exactly what you've just asked. And you do need to understand this to understand how broken your system is. And it's worthwhile watching. So what actually happens is the government issues a contract and says, here's 100 million Australian dollars. We need that. We're overspending on infrastructure, railway lines, paying health. We're importing immigrants on planes. We're doing all of these things that are so noble on behalf of you so that you can be safer and diverse and, whatever their justifications. So they are mal-expenditure, in my opinion, but they're going and doing that. Now they need the market to say, I will give you that money.
Yeah.
And what are you offering in yield? So they'll say, okay, 4 or 5%. I'm not sure what the number would be in Australia right now, but let's say 4.5%. And then they go, great. What actually happens if later, a year later, they come and people don't want to lend them more money? They don't think it's been productive lending. And they say, no, mate, I'm not giving you $100 million again for all those things. If you want me to lend you money, the rate's 9%.
Right.
So I want twice what I gave you before. And they've got no choice because they're waiting on an investor. Pensions are buyers of these things. Treasuries that want to have assets are buyers of these things. And they'll say, we want a better deal. And that's when they have to test the market, because they don't actually go and get disciplined in the market. That would be very embarrassing. So they say, we've got another 100 million we're likely to need. Where are we going to be at roughly? And there's lots of pre-communications. People commit to, okay, we'll bid a certain amount if you come in at that level. So there's actually a lot of calls that go on behind the scenes. If it's at 9%, the guys that did the one before at 4% are getting 4.5% are getting half the yield of the other one. So by virtue, it's worth in the resale market half of what it was. You've lost 50% on your 100 million. Because why must I buy your resale paying 4.5? I can go straight now to the government and buy one that's going to pay me 9.
Yeah.
And I'm interested in yield. I'm a pensioner. I want to, something that's going to pay me a monthly stipend. I'm old, I'm not working anymore, and etc. I want an annuity, but I sold my business. Which one am I going to buy? So for the resale to sell, it has to sell commensurate to what the new rates are. So that is a capital loss. That is huge.
Yeah.
Because we're at the lower percentage, it didn't matter as much when you were at 10% and you went down by 1 or you went up by 1. When you've taken the rates right down to 1% and you're moving by 0.25 or half, these are huge capital losses in the bond markets. This was the capital loss. So if I remove the previous lines I drew on and I'll change colors, we called the top of the bond market essentially here in August, September of this period. And we had the best ride of our life selling puts on ETF to the short side. Now, I explain technically because it tells you, and it's technical as certain rules, things finish in blow-off tops.
Right.
Bull markets typically finish in blow-off tops. So this is the value of the debt markets. The US 10-year Treasury had a huge blow-off top of value. Everybody got petrified. The whole world was shut down. There were no safe places to go. I vote the US government. I don't care what the yield is. At least I'll get my money back. Blow-off top. Typical. Think of the dot-com for people that understand equities, don't understand bond. Blow-off top. It actually goes more violently up just when you think it absolutely can only go down. This is typical of a final event. What actually ends up happening is you get what we call the real hard slap in the face. We make a joke about it when a bloke, is too affectionate to a girl he's introduced at the bar. It's all's going well in the conversation and he brushes her shoulder and that was a little too intimate and that was you've gone too far, too fast, and the slap in the face comes in. And markets get a slap in the face. And this is a violent downside reaction in the TLT, which is an ETF, and this is the chart it makes. it makes the chart like this. So I've flipped the chart. I inverted the scales to help it understand. But the corollary of the story is that the interest rates were going down and they can't go any lower. That has bearing for you, my Australian friends, in terms of your property. That has serious bearings if you're thinking of buying a new house.
Right.
If you get cuts at all, you should fix long term. Our overall view now is that these assets, and there's a classic saying, especially when you've had a bull market this long that has got so overbought and so overstuffed and has had a blow off top, is that it's the escalator to the upside and it's the elevator to the downside.
Wow.
So we are talking about an absolute crash. The biggest bubble is debt. It's something we said 4 years ago that even Zero Hedge, the next earliest in the queue with their pals, is now confirming. The bond bull market is over. That means, and it doesn't do quiet sideways bear market. This is a blow off high. Go view the NASDAQ running into 99, 2000. You correct. Amazon went from 108 or $106 down to $4, $5 or $6. We're talking about that kind of correction. And that's a company that survived. That's one that didn't go to naught. Okay, not boo.com, not pets.com. That's not the story. This is your reset. Debt is a much bigger market than a single bunch of tech stocks in a market. This is far bigger than 99, 2000. And most people are sleepwalking through it. Now, the real reserve asset in our narrative of explanation to you that doesn't die and can't be proliferated and won't be printed but pays no interest. So that the story of two assets goes something like this. We have gold, and it gets criticized by the likes of Warren Buffett. You know, gold over here just sits, good old XAU, pays no interest, 0% in interest. And if you use counterparties, you might even have a vaulting cost. As I say, I don't suggest you do that. I say vault at your good old house, home, swimming pool, hiding place of choice. But it's apart from a bit of effort and some time and some good notes, you want to make sure you get the map right. It shouldn't have to cost you vaulting costs. Treasuries, as they were put as the petrodollar, and this is why people talk about the petrodollar. It's less about really the dollar. The two are together, but nobody talks about the debt. What was happening is America was an exporter of dollars and a consumer, a net consumer. Everybody, the fat guy lying on the beach saying, another burger and Coke, please. And bring a pina colada with that. And the Japanese are running around, the Chinese are running around flipping burgers and bringing them to this fat guy who's oafing it all down and saying, put it on my tab, sign here, put it on my tab, put it on my tab, put it on my tab, put it on my tab. And that tab was a treasuries market. They just kept issuing this debt. And then they bullied people to say, this is a great asset. You should buy that. And if you want to sell your oil in Saudi or others, you price it in dollars, creating a huge need for dollars. So people would pour into dollars. And then these selling nations of oil like Saudi, oh, you've sold in dollars. You need to park them up in an asset so that it would be terrible if a war were to break out and you guys were to get beheaded. We'll back you up. But you need to sell in dollars, buy treasuries. So they created a demand for treasuries. And for all of this period, the capital values of the treasuries were going up. Nothing like the equity market, boring, slow. There were ups and downs. You can see it all the way. There we go, up and down. But they were also paying a small yield, depending on whatever the rates were at the time, which continued to get less, which is why this was going up. The interest rates, we rode a cycle of ever lowering interest rates. So everybody could afford things they shouldn't be allowed to afford because we went super low down. This is the key story. So you had T-bills or treasuries as you want, depending on duration. You got paid an interest, let's go 2%. It was at one point, it was more. It was at Volcker highs, 14, 15, I think in even some instances on some instruments, it may have even got close to 20, 2%. And you got told this is the risk-free rate of borrowing. There is no risk. And I'm here to tell you that's the great lie of the millennia, because you just saw a very low volatility market lose since 2020, 45%. That down to there is almost a halvening in your bond market. Now, that was supposed to be the stable. That's why it was the 40 in the 60-40. Equity gave you the high returns. But in the bad years for equities, when people were afraid, they bought the stable thing, and it would go up a little bit and pay you a little bit of interest. It was the rock, the stabilizer, not too volatile, but safe. Now you've just had a 45% in a period from the peak of 2020 down to 22, 23, and it isn't over. It isn't over. The chart that I'm actually showing you here, which I've now inverted, if we drop into this analysis here, you will see it's still there, is setting up for the next down leg. Because I've inverted that, it's a down leg in valuations for bonds, but it's actually an up leg in rates. So this is known as a rising wedge, and as I say, if I turn it back around, it's a falling wedge on the other side. So our prognosis for interest rates globally, because you are all part of the leper colony. How did America get away with doing this for so long? All had to do the same and copy America. There couldn't be one nation that was sound money nation. Some might say, well, the Swiss franc's not bad, Singapore dollar, etc. But generally, the globe is over indebted. You can't say Europe's better. You can't say the UK's better. You can't say Australia hasn't had their debt surge and everything. That's how they didn't get found out. We all had to kiss the chief leper as we came to this party and be part of the leper party. But eventually people start dropping dead anyway. And it's just a case of relatively who's worse off. So this is the key narrative, and gold is the alternative. The risk-free no longer applies. It's guaranteed loss. We are in a hyper stagflationary environment. That means macroeconomically at the consumer and the retail level, you've got stagflation, low growth, and stubbornly high inflation, where you're going to keep getting higher highs and higher lows on the chart of inflation. So if I just make the chart go back to what it was, you can see this is the turn in the interest rate cycle, and there is that falling wedge. Everyone's shocked that we're back up at 4% on the US markets. They can't afford for the rates to go lower. Who buys the debt at that expensive price? People are saying there's too much. We don't want it at that price. It's below the actual rate of inflation, never mind your BLS numbers. And by the time you're giving us the money back, it's going to have devalued chronically. We don't want it. What are they buying? Well, the central banks tell you. They're buying gold. China's not adding to its treasuries. They're buying gold. So actually, the two perceived reserve assets was, while we manufactured capital gains for the bond market, the treasury market and the petrodollar worked. While people weren't losing money chronically, they were getting a low level of interest rate that continued to get lower, but in compensation, they were getting a little bit of capital growth. Gold just stood. It's done what it always does. It's like honesty and truth. It's like the plane that flies at 40,000 feet and all the currencies and debt markets jump out of it. The Swiss bank, the American banker, they all represent the currency and their debt markets. And they say, I'm falling, I'm a little bit better than you, you're falling faster than me, you're falling faster than me. But the truth line is the plane at 40,000 feet that starts getting smaller and smaller. Every asset you are contemplating, you should divide by gold. That is your inflation debt collapse indicator.
Okay, so before we get into gold, let me just ask you two quick questions. Because you said, because the Federal Reserve turned around and said 50 basis points off of, we're going to lower the interest rates by 50 basis points. You just said, if I understood correctly, that we're actually going to get interest rates going up. So why have they done 50 basis points off if ultimately they're going to be raising? Was it just a false flag, if you like?
It's what the market will allow, that they think they can get away with. So we've got to talk about time frame. Initially, this has all been down for interest rates. That was all the and over here, we are going slowly up. I don't think it's going to be chronic. I think we go up. So we will. The market will say we are not so comfortable with rates low down. In other words, valuations need to be lower. There's not enough bid under the debt market. But then there's going to be a third scare. So we'll have a war. We'll have a pandemic. We'll have events. Guess. I don't know. I'll leave up to you. Yes. So boom, we drop down again here. And then everyone will go, you see, it's only going to get cheaper. That's when you homeowners that still have debt on your property should fix. Bang, at that point, technically. Because what I feel comes next, technically, will be a breakout to the upside. So I've got to be careful if I just say rates are up. There's still a possibility more cuts will come in the short term. We're only here, we've got this bit to do. There's a bit of up, there's a bit of down in that. On the macro time frame, take this chart up to the monthly and say, Francis, where will rates be in 2 years' time? Higher.
I'm not seeing the chart anymore.
Apologies. I stopped the share. Let me put that back in. I'll say that.
Yeah.
When I say rates up, we've got to talk timeframes. There's timeframes under review. The macro, monthly, annually. If you ask Francis 2 years' time, where will the rates be on the US 10-year yield bill? I will say higher. In between, I think we could go higher short term now, but at some point also, to complete the pattern, we typically get a sell-off, and I'd say that would be associated with a bit of fear, concern for the economy again. That's all going to come in. Now, the media will focus on whatever it needs to. The consumer is wrecked. They could be focusing on that now, but they're not. Why? Because because the bond market won't allow them to drop the rates too far. So they're walking a line between what they can get away with for investors to still buy the debt instrument versus what they have to do to keep the people happy.
And this is where I'm going to say to all of my beautiful community out there, this is why it is so important for you to go and listen to people like the Market Sniper instead of the mainstream media, because they'll lead you down the path of destruction, and Francis will rip off the blindfold and say, no, this is what's truly happening. And this is why this is such an important conversation I'm having today. And I'm so glad we're back in contact, because I want to have you on more often. I think it's very, very, this is key information for you. And by the way, ladies and gentlemen, not financial advice. You need to do your own research and your own homework, but the charts will help you to understand what's going on. So please continue, Francis.
Yeah. So the overall trajectory is for your long-term planning to expect debt collapse and higher interest rates. That's the summary, the short one-liner.
Okay,
in the meantime, there will be, as I was highlighting, some ups and downs in that, which is why I was drawing these pink lines here for you. We can go a little bit up, but then they'll have a bit of fear, and we'll be focusing on how everyone's battling and whatever, but then we go higher. So 2 years' time, higher rate. Why must they put rates higher? Can't the central bank, if everybody's in pain, make them lower? No, because the central bank doesn't have complete control over the rates. The debt markets control rates. You're expecting someone to take the other side of a trade. I don't want to buy debt. On the 60-40 portfolio, we mentioned this just before, you had someone who said, well, I turned it right down to 15% in debt. My answer is, it's naught.
It's okay, and by the way, ladies and gentlemen, what he's talking about is bonds. So
the bond allocation.
Yes. Bond allocation. So if you were listening to Ronnie Stofley, we were talking about the old portfolio versus the new portfolio, the old portfolio being 60% equities, 40% bonds. That's just what generally people recommended, if you like. But now Ronnie's turning around and go and watch it. But it was, a certain amount in equities, but the standout was 15% bonds. And what Francis is saying is zero.
Yeah. I want to show some respect to whoever the previous person was.
Oh, he's fantastic.
He's gone and he's recognized a lot of things by reducing that. And that's portfolio theory. It takes a while for people to let go entirely of an asset class. He's gone and he's recognized the failure of the 60-40 portfolio. He's substantially reduced his exposure to that. Yes. But it was supposed to play a role of a stabilizer, something that retained value and even got bid up slightly at the big fear moments. It was counter indicative to whatever was going on in the equity. When everyone was bullish and optimistic, they were chasing stocks. Bonds would lag a little bit, but they would at least pay you some interest. And then suddenly, when there's crashes in the equity market and you're having a bad year, the fear of that money used to go into the safe trade, and actually you'd get some cap appreciation on bonds, and you would also get a yield. It was a stabilizing factor to your portfolio. It reduced the volatility of risk. Often, many people don't realize this fact, and this is one of the critiques of Bitcoin I have, is you need your money most during the downturns. Not at the high points when everyone's feeling chipper. You've got no problem getting a loan or extending your credit card or asking for a raise during the high points when everyone's making money. It's at the bottom when all the businesses have shut of March 2020 or the crash of 1987. So you don't want to have to be a seller of Bitcoin. Bitcoin on just the Japanese yen trade fell 30%. Its downside beta is as high as its upside beta. So the value that bonds gave is that it didn't have volatile capital movements to it. The minute the previous chart I showed you with the blow off and the 45% crash occurred, I'm saying to you, it's no longer fulfilling purpose. It's supposed to be a stabilizer, and it was the volatility. Because we've reached peak debt, the financial information for your time worked for a period, whilst they could get away with it. And the key part about reset is the financial advisors of today that are still trained in bonds and equity portfolio allocations are still playing the last wars. They're still fighting the war with the last weapons. It is no longer fit for purpose. It has failed as a stabilizer, and it isn't giving you the upside of NVIDIA and the NASDAQ.
Right.
So if you're not getting the high beta upside, but you can lose 45% over 2 years, what the hell are you doing in it? You may as well be in Bitcoin, because at least you can get maybe to 150,000. Remember to take some off. You know you're going to get a 60% pullback or a 40% pullback at some point. But that's usually when people need the money. They don't sell on the high. They're in greed state. And that is where HVF method comes in. If people don't have planned exits, greed keeps you in the trade, and only pain is what takes you out. And the problem in this world is we've become a central bank controlled world. It's binary. We all feel pain at the same time because the liquidity providers and extractors are providing and extracting, and it's affecting all of us. They're running the game. We're on their ant farm. They stand on us in the ant farm. We all get crushed. So that is your concern.
Why is the Hunt Volatility Funnel so good at what it does?
So I'll give you an excellent example of an HVF trade. The key value of it, in fact, I'm going to jump a little bit ahead because I don't know how much time you have, and I've got to respect that. I've got all the time to talk about these topics. I'm passionate, but you might want to keep your interview to 1 part or 1 hour or whatever. But here's an example of a gold share with an HVF draw. This draw tool is made available to all my community members. They just need to understand. They have to have been with us for a year, and they get it. Full life to use as long as they remember. So this is IRA, gold,
Not seeing it yet. Please share.
Thank you for reminding me. Sorry, I keep switching it off because I don't want to spoil. I don't want to spoil the dynamic. So here's IRA, the stock. And this is a classic case of a Hunt Volatility Funnel setup. What is it? Well, Hunt is me. Volatility, we say volatility is one of the most important things that people don't understand. I've just been talking about the downside beta. You want something stable. It's like your grandfather. He's always in his rocking chair. He's always friendly and kind, and he'll let you have a suck on his pipe. He doesn't want to take to thrashing you or throwing huge gifts at you. So volatility, when things get low volatility, it's a squeeze. It's typical of a squeeze. And we recognize that as being a gift, because what happens is volatility is always there. It's a bit like the tide. It comes in and goes out. But for sure, for those of you that live near the coast, what goes in will come back out, and what goes out will come back in. And in fact, when a tidal wave is going to come, you actually first get a huge amount of water withdrawing from the beach. So we love extreme lows in volatility. Think of that tide, all the water. We say there's a tidal wave coming. Everyone else is going, isn't this funny? We've got to go a whole bunch further for a swim. Let's go. We're going to go further. Look at all these clams that are lying in what used to be the water. Ha, 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 ha. And we are preparing for something totally different. We're getting our small windsurfer sails on and ready and getting ready for the ride of our life. and the other people are going to drown. Why? Extremeness in low volatility leads to sudden returns to extreme high volatility. And the difference is we can get a very tight stop. So the HVF, the stop on this is here, 6.87 Canadian dollars, and the breakout point is there, the green line. And we put all of this data in here, and we have the risk reward always shared. And you can see at 7.75, and the target is expected there. So interesting is the HVF method. To me personally, I would say that, is that we even tell you where it's going to pause for a while. You can see interim levels here, here, and then before the target. So we tell you, hey, you're going to have to be patient during this period. So you get a nice move up, and then you don't make progress for a while. Isn't it nice to know that at interim level, if you're holding and not going forward, it's okay. It's going to continue. It's part of performance. But, and you can see it doing it again here on the second interim over there, having a little pause, having a little pullback. The end goal, though, is it finishes through there. This is a small time frame. I wasn't expecting to be called on one, but I was going to mention this as a stock, and I had the chart up, so I've shown you. That is a 7.75 return. In a market where the underlying is broadly bullish and is likely to remain so. Yes, there's going to be pullbacks, but it's going to my take 2,900, it's going 5,000, 6,800. We've got targets 7,800 gold. We put out a video yesterday, and I will show you those charts. $330 in time as part of the crisis in silver. Huge call from where it is now. But that isn't going to be the same dollar that you're used to. So we will definitely have to show you.
If we can cover gold and silver quickly before we finish up, that would be amazing. Because I know that a lot of my audience out there, I mean, I always often say, Francis, I say, gold is money, everything else is credit, and the governments around the world, you know, they've drunk the Kool-Aid and they're going to keep printing the funny money, or the funny currency,
Absolutely.
I should say.
You're quite right. You're absolutely right. So what I've done, two charts, and I've split them. Then you're not looking, I will go to a plain gold chart in a minute, but we like to cross-analyze a lot of things. The left-hand side is gold divided by the US CPI number, which we all think is understating, but we've taken it as face value as available. And the right-hand chart is the silver chart. And both of these are the biggest. So I was born in 1968, right there. The worst part of the gold market and the silver market. In that time, and I remember this because I went to school and there was inflation and we weren't even allowed to cover our books and spend money on that to save, you know, all of these cranky little education techniques and tricks. We had the 1980 run. Then we had this was peak Volcker, interest rates. So you see the date there, 1st of Jan 98. Then we had peak interest rates. He bought, by pushing the rates up that high, he devalued debt immensely. And it was the stagnation. New York was an absolute, I'll use the Trump phrase, but I won't for that purpose. And everything was just dour. It was stagflation. It was rubbish, all sorts of things. It was, the people were not doing great. Then the financialization of everything era came, took us into the year 2000s. 1st Jan 2000. That's when gold started to hang on. These guys have gone really far. They're still going to go further with their debt experiment. But now we're starting to show some relative valuation with this inflation number. And gold started to perform, and we had the part bull market of 2011. That was really a small bull market, but it's enough for the second upside impulsive wave. Then we got put in the can since 2011, and we refinancialized, and we've extended, and we found new credit cards to put money on, and we've literally scraped the bottom of the jar out, and we got gold a little bit down, and then boom, we got the splurge of CV19. That pushed us back into the, hang on a minute, you aren't just scraping the peanut jar for a bit more, you've borrowed and bought a whole 10 peanut jars. So we got a little bit more concern with the debt virus situation with that. We got another bump, and then a pullback as they started to tighten rates again. And now we are here. This is our pattern, literally. The three impulses very ascending structure. And I'm here to tell you that my whole lifespan literally is the story. You have the biggest pattern, and biggest patterns give biggest targets, biggest moves, biggest everything. That has triggered this year of 2024 from my 1968. That pattern has triggered a move that will see this chart go through there. Now, 52 means nothing to you because it's something, it's gold divided by the inflation rate. But I can tell you it is vast. This is a log scale. You're only at 8 at the moment. So you need to think in the terms of about 6 or 7 times, 6.5 times where you are now on an on-target performance. Just to give you an idea of proportionality. And you can see how fast, when we do have real big runs, things go. And I'm here to tell you that the 80s was nothing compared to the stagflation you're going to have. That was stagflation. We're going to be in globally synchronized hyper stagflation, where taxation is going to go up because they can't find the money in the bond markets anymore. They're going to come and try and get it out of you at the 100%. Same time as cutting services to you, by the way. So your garbage will be picked up once every 6 weeks instead of once a week, or once every 2 weeks. Your water is going to cost you more. This is going to cost you. There's going to be a levy for everything. There's going to be indirect taxes for absolutely everything. And the currency's buying power is going to devalue immensely. This is going to be, in terms of financial mood, it's going to be like the 70s. I wanted to describe the drug pushers and the 70s of New York.
In what period of time are we talking?
Well, it's begun. You're already part in it, but it's going to get far more extreme. However, the protection that you get if you are in you've dropped the T-bills reserve asset to naught, and you just put that allocation to gold. So going back to your previous speaker, I think he's correct in the movement and the direction he's moving in. I'm not dissing him. I'm just more extreme and faster to move and more imbalanced. Many people aren't running an elaborate portfolio with minor percentages here. You might just have gold and some shares, and you could do just fine. Take whatever you ever had for bonds and add it to your gold allocation, because this is going to be the thing. People say, well, I just do it for stability, it's insurance. No, it's the only thing that's going to hold value and number go up in an environment where many things won't. And you can have sideways stock markets that are actually crashes because of the stagnation in real terms, because the money's being devalued for ages. And in fact, the era before the 80s, that from 1980, I'm trying to remember now, the bull market only really sort of started in stocks once the interest rates got cut, Volcker's era. The 68 to 82 stock markets were terrible. Now, we could have 3-4 decades of that. You saw it in Japan. Everybody calling this year Japan, this year, after the 1989 super boom. And we're in that point. Japan is a country that is demographically about 15 years ahead of us, and we're now about to get that bit. So I think outside of miners and some things, a lot of stocks that do everyday things, their margins are going to get squeezed. Their ability to put prices up too high are going to be difficult to crush consumer, while at the same time their input costs are going to be going up. It's going to be a difficult commoditized game. So that setup is the gold divided by inflation. And then I'm coming to silver here to finish this chart.
Before you go on to silver, you did mention property, and in Australia we are obsessed. Literally obsessed with property.
Like the UK, yeah.
Are you saying that the price of property won't crash, but it will cost you a lot more?
Underperform.
It will underperform.
So the problem is debt. The problem is we've let the financial parasites into the property market to the extent that there's I'm reading about US vets in the States. I don't have too many anecdotes on Australia. I'm coming to Perth, by the way, in January. So I'll have a look around. But indebtedness. And if the indebtedness, the ability to borrow and indebtedness, prices are dictated at the margin. If suddenly the environment for debt changes and interest rates are so high and so few people can borrow, all simultaneously combined with a wrecked consumer whose food costs are going up, input productions are going up, salaries are lagging the inflation, how do you buy a property? Well, you've got to have 50% down to get a decent rate, or 30, 40% at least, and banks will look at you all over, and they're going to be very, very unreliant. If we still have the banking system as we know it today, because such will be this debt collapse, I think the opportunity Remember, never let a crisis go to waste. Well, they manufacture the crisis and then they implement their plan. That's the real truth of the matter.
Yeah.
And the CBDCs and all of that, UBI and a lot of things. Next thing you know, the equivalents of BlackRock, Vanguard, and State Street own most of the properties and are institutional landlords, and most people rent. You will own nothing and be happy. If you just think that was some young Danish girl's essay on a whim, I'm here to tell you, I've got a bridge to sell you in San Francisco. This is their goal. That is their objectives. So property, in what I've just described, it's a high water mark. The debt market collapse, it's a high water mark. What gains you think you're getting are actually true reflections of the inflation. You should divide your housing index by gold, and you should recognize if you have debt on that, you will not be able to refinance. You're going to be refinance trapped, or you'll be a forced seller. So if you've got a 2-year deal or a 3-year discount deal, I'm not familiar so much with the structures of loans in the Australian bond market, but anything that was a teaser rate, when it comes to the end, you're working on getting another, you're going to get caught. The only thing you could do is a fixed deal at current rates. Then they can't put the rates up for you until such time as they say it's not in their interest anymore to offer you this product. So in other words, they can still cheat on you. So if you think a fixed deal will protect you, it might for a while. But there's nothing with bankers and legalese that you can actually ever trust. So I own property. I'm fortunate. I've worked for a long time and got reasonably productive eventually when I sort my stuff out. And I have no finance at all. Because anything that owns finance means you are in business with somebody else who is also an owner. And that owner determined the deals under which he's a partner with you, not you. You signed his document, and that right there is your problem. So my personal advice, and I'm non-regulated to advise, so this is what I've done. I just recount what I've done. You come to your own conclusions. Have as little or no debt as possible on assets, to the tune of rolling in your horns and looking like you're retreating. Let everyone go, oh, you've lost your stomach for this business, have you? Ha, ha, ha. Rather have, if you've got 20, buy-to-lets or whatever the case may be.
You do what people did way back in the day, Francis, and that is you have the real money. When things get a little bit difficult, you can go back in, and what people can buy today, you'll be able to buy with half the amount, if that makes sense, because gold will hold its value. All right, let's just silver very quickly if we could.
Yeah, pricing is a determinant of what a bank will lend you, unfortunately, and it shouldn't be that. We used to have to save all the way to properties. That's why they were called building societies. They were saving plans, and that's why prices have gone so extra normal high. So silver, I wanted to just put them next to each other so you could just see them. Now, obviously, they're precious metals, so there's correlation, but this is beautiful similarity in silver as there is to gold. It's the same high. It's the January 80. There were 2 tap out lows here. So silver had a kind of stall box zone, while gold had quite a sharp V point. But it was .com, as you can see for gold. You got your first low at 91 for silver, but then it was needed more industrially. So it didn't go lower. And then around 2001, it had a technical low. So it's kind of a box low. They both ran up for the 2011 high, which, as I've said, that was your half a bull, if even a third of a bull market. Even though we loved it at the time, it was short time. We got a technically higher price for silver here than there. But you've got to remember, there's a 31-year difference between these 2 highs. So for me, we just took that imperfection out. That makes it still be what we call an HVF. You got the spill to $14. And that's where silver has the higher downside beta to gold. So start with gold, and we pivot into silver. Always start with gold. You don't tend to get gold on that CV19 event. It dipped, and in the same month it was back up, and then it went higher. That's the kind of asset you want. Ones that perform well on the downside, because that's when you're going to be needing your money. Yeah. And that's a point I keep making. RH3, RL3, again, 2021, we had the high when gold went to 2075. Silver did too. Then we got dipped down. This is also a triggering event at the same time on a macro upside HVF. Patterns that have taken my entire lifetime to build are now triggering, and that's the log scale target. These huge moves, people would have thought you're insane at one $1.28 for silver if you ever said to them $50 or $49 is coming, because that's 45 times up. And it's going to sound insane to say 100 times up to people where we're at 31 at the moment, and you've got some guy on the other side of the world telling you it's going through 330. The scale of the debt collapse, the cessation of it as a plausible asset, hence why I said zero and bond. They can't. They're going to have to push interest rates higher. If you needed to kill the Vietnam inflation, remember, that was all tricky Dickie Nixon, who took us off the gold standard in 71, who was overspending in Vietnam. They dropped more bombs than they did in all of World War II, the Americans. That was a military-industrial complex heist. They made huge amounts of money at the expense of the American citizen, put us debt on them. It took Volcker raising rates to double digits, going almost to 20%, to actually bring back semblance. So imagine you had 20% today. Imagine first there was someone with the will to do what Volcker does. There isn't.
That's true.
Second of all, imagine there was, and he did. How's your property looking if in Australia? It becomes a loathed asset class that nobody can sell, that gets you blacklisted, credit listed, and state takes over, and you end up being a tenant in your own home, and all your buy-to-lets have been taken off you. Prepare for that downside now. That's my message. And silver, and put your excess capital into the likes of what I'm talking about now, because preservation of capital, not return on capital, return of capital. Preservation is the game. Yield is no longer the game. You're going to have bonds that are going to be yielding double digits in a couple of years' time. I have very little doubt across the world, and eventually America too. And that's still not worth buying, because the capital values will be crashing. The debt market will have to go through a bear market like the gold market did before people will start treating them as assets again. Such will be the burn. You know what uranium went through, all of these things. Buying debt as an asset. Pensions are going to have to be structured. There's going to be pension crises. If you think your pension is going to be good for it, forget it. Unless they're in gold and silver and it's self-invested by you, they're probably stuffed with bonds. They're in cahoots with the government and buying, oh, but this is what we were told. This is a stable, safe, you're getting old, nice, not moving too fast. It lost 45% in 2 years. It is not stable. It's over.
All right.
The game's up.
Game's up, ladies and gentlemen. The game's up. And Francis, Sniper, Market Sniper, the game's up. It has been a fascinating conversation. I really, really, truly have appreciated it. I'm so glad we've reconnected. Let's get you back on as a regular guest to Making Money Matter, because at the end of the day, as I said before, gold is money. Everything else is credit. I don't call this channel Making Credit Matter. It's called Making Money Matter, ladies and gentlemen. I want to make it matter for you. You will find nobody better than Francis Hunt, the Market Sniper. I want you to go to his YouTube channel. Go back. Make sure you subscribe, because then you'll get all of his updates. It is so important for you to understand that this is a man that gets what governments are doing to destroy your wealth, to keep you in the serfdom. And that's what I want you to understand. So stop watching Netflix, start watching Market Sniper. I'll get him back on again more and more, because I am passionate about ensuring that as you go forward, you're in good shape, because the governments are not, and Francis just said it, they're not going to look after you with your so-called pension when the time comes. You have to create your own wealth. And the way to do that is with sound money, which is gold and silver. I was a little bit shocked about what he said about the silver price, but there have been murmurings, and now I think it has been absolutely clarified for me. So we'll be looking forward to having you back on again. And if you're in Perth in January, sounds like he's going to be over there. So, wow, Francis, what a great session we've had. Let's get you on again. Great to be back in touch. I'll put the links down below. But as I said to you before, ladies and gentlemen, go subscribe to his X channel, to his YouTube channel. Very important. And there you'll constantly get the updates. But for now, thanks so much for joining me on Making Money Matter.